Welcome to the Coin Bureau Weekly News Roundup. Here are the top stories in crypto this week. Down real bad. BTC tumbles below 60k just days after surpassing 70k as spot Bitcoin ETFs see their largest net outflows in 3 months. How low could BTC go? Ethereum turns 9. The second largest crypto hits a big milestone while investors eye so-called Ethereum killers. Why ETH could be about to surprise to the upside, assuming this correction doesn't get any worse, of course. Tether's record profits. Crypto's largest company reports billions of dollars in profits from the reserves on its USDT stablecoin. What does it mean for crypto? Recession fears arrive. Investors panic after US unemployment figures come in much higher than expected. When could the recession begin? And a closer look at last week's top-performing cryptos, for what that's worth, and where they could be headed next. All this and more in just a moment. Last week, BTC saw unbelievable volatility, rallying to over 70k at the start of the week and almost closing the week below 60k. As we shoot this, it's around 54k. Now, the reason for this extreme volatility is the same as always: leverage. There were hundreds of millions of dollars of longs which got liquidated, causing BTC to fall fast. So then, what triggered these liquidations? Well, besides investors going irresponsibly long when BTC broke above 70k, it seems the trigger was a combination of bearish crypto and macro factors. On the crypto front, there were concerns that more Bitcoin whales would dump BTC. It wasn't Mt. Gox or the German government that BTC investors were scared about. That's old news. This time, it was a combination of bankrupt crypto trading firm Genesis, whose creditors were sent over $1 billion of BTC, and the US government moving $2 billion worth of BTC, presumably to sell. Meanwhile, on the macro front, economic data came in slightly stronger than expected, and the Federal Reserve subsequently decided to keep interest rates where they were before going off on their summer break. Now, obviously, the day after, the unemployment figures were released, and they surprised to the upside. But more on that later. Now, as a cherry on top, the spot Bitcoin ETFs saw almost $240 million of net outflows in a single day. This is significant as it was assumed that BTC was now seen as a safe haven by investors. The fact that they sold when recession fears arose suggests that BTC is still seen as a risk asset. Now, the sell-off we're seeing across all markets is in large part due to another macro factor, and that is the yen carry trade. In short, investors around the world borrowed trillions of dollars worth of yen to buy other assets, including crypto. Now they need to repay those yen loans, i.e. sell everything. It's possible that the unwind of the yen carry trade will continue to keep markets suppressed throughout the week, but it's safe to assume that the powers that be are trying to minimize the volatility. Fortunately, any kind of intervention will involve money printing, which will eventually boost crypto. So, if you're brave enough to trade these tense market conditions, then use the Coin Bureau deals page to maximize your profits. It's got trading fee discounts of up to 70%, sign-up bonuses of up to $100,000 on the best crypto exchanges, and much more besides. These deals are only available to Coin Bureau viewers, and they won't be around forever, so take advantage of them using the link down below ASAP. And while you're down there, smash that like button if you're enjoying the video, and subscribe to the channel and ping that notification bell so you don't miss the next one. Now, on a more positive note, Ethereum turned 9 years old last week, specifically on the 30th of July. Ethereum creator Vitalik Buterin posted a photo of what is presumably Ethereum's launch party. It includes some of Ethereum's original co-founders, including Polkadot founder Gavin Wood. Crazy how things change. Anyways, Vitalik added that he's excited to see what the next decade brings for Ethereum. The top reply from Autism Capital perfectly captured the broader sentiment, quote, hopefully a pump. In all seriousness, ETH has continued to underperform BTC, all while Ethereum killers gain traction. As you can see, ETH is at risk of falling to lows against BTC not seen since 2021. To be clear, this doesn't mean that ETH's price is going to fall in fiat terms. It either means that there will be a rally, but BTC will rally more than ETH, or there will be a crash, but BTC will crash less than ETH. To recap, the ETH-BTC pair is important because it gives us a sense of how altcoins are doing more broadly. When ETH-BTC is rising, it means altcoin season is coming soon, and when it's falling, it means that alt season is slipping further away. With a bit of luck, ETH-BTC will see a bounce in the coming days. Regarding the so-called Ethereum killers, meanwhile, some of you may have seen the news that Solana recently surpassed Ethereum by weekly fees, with the Pump.Fun meme coin generator accounting for more fees than all of Ethereum in a single day. At first glance, this is bearish for ETH, but it misses the bigger picture. When you zoom out and include Ethereum's layer 2s, it's clear to see that Ethereum's growth is as strong as ever, and that no other ecosystem comes close, at least for now. This is of little consolation, though, to those who have been fixed on ETH's day-to-day price action, but it seems there's a catalyst coming there too. As we highlighted in our recent Ethereum update, Ethereum appears to be becoming the chain of choice for asset managers to issue their tokenized real-world assets on. This makes sense as Ethereum is technically the most secure smart contract-compatible cryptocurrency on the market. At the same time, the launch of the spot Ethereum ETFs has opened the door to a new cohort of investors who will ape into ETH the next time they hear about another asset manager doing stuff on Ethereum. This will increase ETH's on-chain value, making it an even more popular form of collateral. In turn, this will likely result in a lot of borrowing within Ethereum's ecosystem, which will boost the prices of just about every token in it. This would explain why Aave had been rallying before the whole market went down the toilet. Aave is the largest DeFi lending protocol on Ethereum, and Aave token holders could benefit if that fee switch is passed. Topic for another video, I'm afraid. Anyhow, the key takeaway is that ETH is positioned for a mind-melting recovery rally. In addition to the improving fundamentals, the fact that there's still so much FUD in Ethereum's ecosystem suggests that lots of traders are irresponsibly short ETH. Of course, this would make the recovery rally truly impressive. Now, as I record this, ETH is around $2,400, having taken a beating along with the rest of the market. Now, this level is critical because it's where the Bollinger Band moving average on the monthly is. Being above this level means ETH is in a bull market, and being below it means ETH is in a bear market. Now, another fundamental reason why ETH is likely to do well in the long term is because Ethereum hosts most of the stablecoins in circulation. This is, again, due to it being the most secure smart contract crypto out there. And this is one of the reasons why the continued increase in the supply of USDT is bullish for crypto. If you watched our video about stablecoin market caps, you'll know that USDT is used primarily for leveraged trading. This is why you see billions of USDT being printed every time there's crypto market volatility. It's literally just traders buying USDT so they can bet on crypto prices going up or down. However, there is a way that USDT impacts crypto prices directly, and that is via Tether, the company that issues it. To refresh your memory, last May, Tether promised to use a portion of its monthly profits to buy BTC. Logically, this creates a bullish tailwind for BTC, which, depending on when these buys happen, could support its price. It also underscores the significance of Tether's record-breaking profits, which topped $1.3 billion in Q2. To put things into perspective, Tether has made $5.2 billion in profit this year so far. Although it's not clear how much Tether has invested in BTC, it is clear that the company is expanding aggressively. This is clear because Tether's Q1 profits were over $4.5 billion. Considering that USDT's market cap has increased while the yields on its reserves haven't changed, the only reason for the smaller Q2 profits is that Tether has been spending money on its operations, which are expanding beyond stablecoins. This is interesting because it suggests that Tether is trying to stop becoming a stablecoin-only company. And it makes sense that the only reason why it would do this is because the company believes USDT's dominance will decline. Funnily enough, this seems to be happening because of regulations. In case you missed the memo, the EU's MiCA regulations came into effect at the end of June. The TLDR is that they restrict stablecoin access to EU users. Oddly enough, Circle's USDC managed to make the cut. Not surprisingly, USDC's dominance within trading is increasing and USDC's market cap is growing. This is fascinating because USDC's primary demand driver has been DeFi. It seems that Circle is slowly trying to take more of Tether's stablecoin trading pie. At the same time, Tether seems to be pushing to turn USDT into de facto offshore digital dollars with initiatives like its extensive Telegram integration. More about that in the description. I digress. Now, the key takeaway in this case is that the demand for stablecoins continues to grow. This is evident in the fact that the market caps of USDT and USDC keep climbing. What's eye-opening is that even the market cap for PayPal's PYUSD has been growing. FYI, PYUSD's purpose is crypto payments. Say, did you know that payment stablecoin related regulations are being worked on in the US? Probably nothing. Now, this brings me to what has probably been the hottest topic over the last 72 hours, and that's the prospect of a recession. If you've been keeping up with the Coin Bureau, you'll know we actually did a deep dive into the possibility that a recession would be starting and what it means for the markets. Link to that video is in the description if you missed it. To summarize, recessions often begin much earlier than they're officially declared or are even identified. In this case, everyone is worried about recession risks because the unemployment rate for July came in much higher than expected. This triggered an indicator called the SARM rule, which predicts recessions. The catch is that the SARM rule is technically a lagging indicator because it uses a 3-month rolling average. In plain English, the recession could have begun as long as 3 months ago if we're using the SARM rule as the measure. Lo and behold, crypto has been crashing for about 3 months now. Coincidences aside, if you watched our video about the possible recession, you'll know that another way to tell when one has started is to look at unemployment by state. When unemployment is rising in every US state, then the US is in recession. Well, this happened late last year, specifically October 2023. What this means is that it's possible that the US has technically been in a recession since late last year, and you'll recall markets crashed a lot back then too. The catch in this case is that it assumes that unemployment is an accurate way to assess whether a recession is here. As pointed out in a recent video by macro analyst Joseph Wang, the sharp rise in unemployment was not due to a shortage of jobs, but an oversupply of labour caused by the enormous migration the US has experienced. The fact that this has been happening for a while suggests earlier prints were skewed too. Put simply, the SARM rule or any other unemployment-based indicator may not be giving an accurate picture as to whether the US is in a recession or not. And if you believe that these indicators are correct and not being warped by things like immigration, then it means the recession began many months ago. And this means that most of the market action related to any recession has probably happened already, at least in crypto. Remember that most cryptos have essentially been crashing since spring, which is when the recession could have started per the SARM rule. Stocks are just late to the party, so to speak. And just as how crypto was the first to arrive at the crash party, it'll also be the first to leave, as it's the most sensitive to liquidity and the most forward-looking. In plain English, if a recession has in fact begun, then crypto will be one of the first asset classes to recover when the Fed starts printing. And with all that said, it's about time we looked at last week's top-performing cryptos. Now, given how the market currently looks like the denouement of a Tarantino film, talking about last week's top-performing cryptos does feel a bit like dancing on someone's grave, but, well, sometimes, folks, you just got a boogie. So, last week's top-performing cryptos were Tether Gold, PYUSD, USDT, USDD, and USDC. Whew, exciting times. So, Tether Gold's XAUT token appears to have pumped due to a combination of the appreciation of gold's price as well as the flight to safety within crypto over the last few days. As a fun fact, gold-pegged tokens often depeg to the upside during market stress as traders hedge themselves. Given that XAUT effectively mirrors gold, it's better to look at the gold chart to get a sense of where it's going next. Now, we may be mistaken, but it looks like gold could have put in a local top and could be in for a sizable correction in the coming weeks. This could happen if markets experience a quick recovery. And finally, we have PYUSD, USDT, USDD, and USDC. These are all obviously stablecoins, so there's not much TA to be done, but there is one thing worth mentioning. The market caps of PYUSD, USDT, and USDC continue to grow, and you'll recall that this is fundamentally indicative of more money flowing into crypto. And USDD's presence is similarly noteworthy as it didn't depeg during last week's volatility. Volatility which was apparently the largest since the pandemic flash crash of 2020. So, if you didn't panic sell, then pat yourself on the back. You've got a stomach of steel and we'll make a hodler out of you in no time. Oh, and by the way, if you want to keep up with which cryptos are pumping and where you can trade them, then be sure to check out the Coin Bureau Insider Telegram channel, linked to in the description. And my friends, that is all for today's Coin Bureau Weekly Crypto Review. So if you enjoyed it, then you know what to do. Hit that like button, subscribe button, and bell icon too. Don't forget to check out our deals page where we have massive trading fee discounts of up to 70% and sign-up bonuses of up to $100,000 on some of the best crypto exchanges, only for the viewers of this channel. Also, if you want to pick up some snazzy crypto merch, then the Coin Bureau merch store has you covered. You can find the links to those resources and many others in the description below. Thank you so much for watching, and we'll see you all in next week's episode.